Hello everyone, this is Nader and this is a new video on how we can understand and read the financial statement. So in this video, we will just compare some figures between the income statement and the balance sheet, and we will try to understand what the numbers trying to tell us and how we can read the numbers and understand the financial statement. So let's start. So the first point we will start is the account receivables and revenue. So account receivables in the balance sheet, it's represent the money that the company need to collect from the clients. However, the revenue is how much sales or money the company make during period of time, and we can find this one in the income statement. So if the account receivable is growing faster than the revenue, it's meaning that the company has a collection issue. The company is making sales, the company is making profits in the financial statement. However, the account receivable is high because the company cannot convert the sales into cash or into real money. So it's mean that the company have a collection issue, or it can't collect the money that she need from the clients faster. So if we saw that, it can mean that the customer is taking long to pay, or the company may have a cash flow problems, or sales quality may be declining. For example, if you find that the revenue in the income statement a million, and the AR or account receivable last year was 100 and this year was 300,000, it means that the account receivable is growing faster than the revenue, which can indicate that the company has a collection issue. Second point that we can see in the balance sheet and income statement, we can compare the inventory and the COGS, or cost of goods sold. Inventory is the product that the company has available for sale. If the inventory is higher than the cost of goods sold, the company may be holding too much stock. And holding a stock, it's not an advantage point for the company, because having a huge inventory can lead to high risk for the company. What kind of risk that the company has if she have, or if she built a high inventory? The product are not selling quickly, or the company may facing a high storage cost, or some inventory could become outdated that the company will not be able to sell in the future. For a quick example, if the inventory is 500,000 and the cost of goods sold is 600,000, it means that the company is holding almost a year worth of inventory. Product may not be selling quickly, which means that the company is not able to sell its inventory within the time frame. The third point that you can look to it is the current assets and the current liability. I know that the current assets, it's the cash, it's account receivable, it's inventory, and the current liability is the AP, it's the payables. So this comparison is known as the current ratio, which is the current assets divided by the current liability. It will help us to understand whether the company can pay its short-term obligation within the time frame or no. If the company is solvent enough. A ratio above 1 generally indicate healthy liquidity. However, a ratio below 1 may suggest that the company could struggle to pay upcoming bills. For example, if you found that the current asset is 200,000 and the current liability is 100,000, it means that the current ratio is 2, which could indicate a strong liquidity, but may also indicate that the company is not investing in long-term assets. It has a huge part of its assets resting in the current assets, like the cash or AR. It means that the company is not trying to invest in long-term production or long-term assets. The fourth point we will understand now is the long-term debt versus the total equity. This is called as debt to equity ratio. It shows how the companies rely on the debt comparing to the owner investment. What this might tell us, a high ratio means that the company using a lot of borrowing money instead of relying on the investors' money. High debt can increase the financial risk, especially during difficult economic time. A quick example, if you found that the debt is 900,000, the equity is 300,000, it means that the debt to equity is 3, which means that the company has or increasing its financial risk. The last point we will try to understand is returned earning versus net income. I know that the net income is coming from the income statement and it's go to returned earning at the end of the year. So returned earnings are the profit that the company keeps in a state of paying its shareholders or paying the dividends. Comparing returned earnings with net income help us understand how profits are being used. What this might tell us, growing returned earnings may indicate that the company is reinvesting in the future growth. A quick example here, if we found that the beginning returned earnings is 500,000 and the net income is 100K, which will goes to the returned earnings at the end of the year. From this 100K, the company pay 80 as dividend, so the ending returned earnings will be 520. It means that most of the profit are goes to the shareholders as dividend at the end of the year. So this will be the end of our video. In the next video, I will try to bring more points that we can understand, but just a quick summarize of this video. So we saw what is the relationship between the account receivables and revenue, inventory and cost of goods sold, the current assets and the current liability or the current ratio, long-term debt versus equity or debt to equity ratio, and the last thing is the returned earnings versus net income. So in the next video, as I said, I will bring more points that we can understand. So see you in the next video. Thank you so much for watching. See you.